5 reasons you will regret taking out a 7-year car loan might sound dramatic, but if you're anywhere near a dealership right now, this is exactly the video you need to hear before you sign anything. On the surface, a 7-year loan sounds harmless. The monthly payment looks smaller, the salesperson seems extra friendly, and you feel like you finally made it because you can drive off the lot in something shiny and new. But under all that polish is a deal that quietly drains thousands of dollars from your future and locks you into years of stress you absolutely do not need. The first reason you will regret a 7-year car loan is the invisible interest bill that steals your money in slow motion. Dealerships and lenders love to talk about the monthly payment. They'll say things like, "We can get you into this car for just $499 a month." And they know that number feels manageable. What they do not highlight is the total amount you'll pay by the time you're done. Take a $30,000 car at around 7% interest. On a 5-year loan, you might pay roughly $5,600 in interest over the life of the loan. Stretch that same loan to 7 years, and now you are paying close to $9,400 in interest instead. That's about $3,800 more, just for the privilege of taking longer to pay. The monthly payment only dropped by maybe $100 or so, but the total cost exploded, and that difference is money that could have been in your savings account, your investment account, or just not leaving your pocket in the first place. The second reason you will regret that 7-year loan is the negative equity trap you fall into almost immediately. The minute you drive your new car off the lot, it drops in value by thousands of dollars. Within the first year, many cars lose 20 to 30% of their value. At the same time, with a long loan, your principal barely moves at the beginning because most of those early payments are going toward interest. That creates a painful gap where you owe way more on the car than it is worth. And with a 7-year term, that gap can last a very long time. Years down the road, when life changes and you want to trade in the car, you might discover that the dealership is offering you less than what you still owe on the loan. Now, you are stuck rolling that negative equity into your next loan, which means you are paying for 2 cars at once inside a single monthly payment. That is how people end up switching cars, but dragging old debt forward year after year, feeling like they never really get ahead. Before we get to the third reason, if you are finding this breakdown helpful so far, take a second to give this video a like and hit subscribe to Everyday Money Explained. It really does help more people avoid these kinds of money traps, and it tells the algorithm that content like this is worth recommending. If you want more clear, no-nonsense explanations about everyday money decisions, that simple click makes a big difference. The third reason a 7-year car loan becomes a long-term regret is that your car and your loan are moving in opposite directions. Your car is constantly going down in value, especially in the first few years, while your loan balance is going down slowly because of the extended term. Over 7 years, a typical car can easily lose 60 to 70% of its value, yet you are still making significant payments in years 5, 6, and 7. That means you could be in year 6 of this loan, writing a big check every month for something that is now worth only a fraction of what you originally paid. If anything happens during those years, like a major accident, a mechanical failure, or just a change in your needs, you will feel the weight of that mismatch. You will feel it when the insurance payout does not cover your loan, or when you realize selling the car will still leave you with leftover debt. The fourth reason you will regret locking in a 7-year term is that it does not protect you from rising ownership costs. A lot of buyers think, as long as I can handle the payment, I'm good, but that is only one part of the picture. Today's cars are loaded with technology, cameras, sensors, and software that make even basic repairs much more expensive than they used to be. Insurance companies know this, which is why premiums are going up. When your car is 3 or 4 years old and starts to move out of warranty, you can get hit with repair bills in the thousands of dollars at exactly the same time that you are still on the hook for years of loan payments. Now your affordable monthly payment is sitting on top of rising insurance costs, higher maintenance costs, and surprise repairs that you didn't budget for. The longer the loan, the more likely it is that these costs will overlap, and that is when people start to feel truly trapped by their car. The fifth reason, and maybe the most important one, is the opportunity cost that a 7-year car payment quietly creates in the rest of your life. Every dollar you send to the bank for a car that is losing value is a dollar you are not using to build wealth. Imagine instead of paying a 7-year note, you bought a slightly more affordable car with a shorter term, or even a solid used car with a much smaller loan. The difference in monthly payment could have been going into an emergency fund, your retirement account, or paying off high-interest credit card debt. Over 7 years, those choices compound in completely different directions. One path has you finally paying off a car that is nearly worn out and worth a fraction of its original sticker price. The other path has you driving a reasonable car, while your net worth actually grows in the background. When people look back after 7 years and realize how much money left their account for that one vehicle, the regret is not just about the car, it is about the vacations they never took, the savings they never built, and the financial stress they kept feeling despite making a decent income. On top of all of this, there is a psychological cost that rarely gets mentioned, but absolutely shows up in everyday life. When you lock yourself into a 7-year payment, you also lock up a chunk of your mental bandwidth. Every time you think about changing jobs, moving cities, or handling a financial emergency, that car payment is sitting there in the back of your mind. It limits your flexibility, it raises your baseline monthly expenses, and it can push you to stay in situations you would rather leave, simply because the payment will not go away. Money should give you options, not take them away, and a long-term car loan quietly does the opposite. The truth is, dealerships push 7-year loans because it allows them to sell you a more expensive car today without you balking at the monthly cost. They get their profit up front, the lender gets years of interest, and you get the long, slow burn of a decision that looked harmless in the moment. The math is not complicated, but it is hidden behind glossy marketing, big screens in the finance office, and friendly talk about making it fit your budget. Once you see it clearly, it is hard not to feel like the system is designed to make overspending on cars feel normal and responsible, when in reality, it is neither. If you are already in a long car loan, this is not about shame. It is about awareness so you can make your next decision better than your last one. You might choose to keep the car but attack the principal and pay it off early. You might downsize into something more reasonable and avoid rolling your negative equity forward. You might decide that your next car will be used with a shorter term, even if it does not look as flashy in the driveway. Those choices are how you start taking your financial future back from deals that looked normal but were actually quietly expensive. If you found this breakdown helpful and it made you think twice about stretching that car loan, do me a favor and like this video, subscribe to Everyday Money Explained, and drop a comment telling me what kind of car content you want to see next. Have you ever been stuck in a long car loan you regretted, or are you shopping right now and trying to avoid that mistake? Your stories and questions help shape future videos, and they might be exactly what someone else needs to hear before they sign on the dotted line.